Credit control is very vital for any economy. And for that, the Central Bank of Economies use two types of methods. First, the quantitative methods, and second, the qualitative methods. Today in this module, we are here to explain you about the qualitative methods of credit control, popularly known as the selective credit control methods. Hello everyone, I am Dr. Shumaila Hassan, Department of Economics, the Bhopal School of Social Sciences. At the outset, let's discuss what are we going to cover in this module. First, we'll talk about what is qualitative credit control. Then we'll discuss about margin requirements, regulation of consumer credit, rationing of credit, moral suasion, publicity, and direct action as the qualitative credit control methods. Let's first talk about the definition of qualitative credit control methods. The qualitative or the selective credit control methods are meant to regulate the terms on which the credit is granted in specific sectors. They seek to control the demand for credit for different uses by, first, determining the minimum down payments which are required, and second, regulating the period of time over which the loan is to be repaid. Now let's discuss margin requirements as a means of qualitative credit control. The method of regulating marginal requirements on securities loans was first used in USA under the Securities Exchange Act of 1934. Control over margin requirements means control over the down payments that must be made in buying securities on credit. The margin requirements is the difference between the market value of the security and its maximum loan value that can be availed by an individual. Now let's take a simple example and understand this better. If this security has a market value of rupees 100 and if the margin requirement is 60%, so the maximum loan that can be advanced for this purchase is only rupees 40. Similarly, a margin requirement of 80% would allow borrowing of only 20% of the price of the security in the market. And if the marginal requirement is 100%, that means the purchase of the security must pay. That means whosoever is buying it, he must pay the entire amount in cash. Thus, an increase in the marginal requirements would mean that it will reduce the amount that can be borrowed for the purchase of a security. Now, this method certainly has some advantages. The advantages of this method are as follows. The first one is that it controls credit in the speculative areas without affecting the availability of credit in the productive sectors. That means we are diversifying the loans which are being given in the speculative sectors to the more productive ones. Secondly, it helps us to control inflationary pressures in the economy by curtailing the speculative activities on the one hand and by diverting credit to the more productive activities on the other. Thirdly, it reduces the fluctuations in the market prices of the securities being bought and sold in the market. Fourthly, it's a simple method of credit control and it can be easily administered. That means the policy just has to adjust what is the percentage of marginal requirements in the coming year in a particular economy. And lastly, the effectiveness of this method requires that there are no leakages of credit from the productive areas to the most unproductive areas in the economy whatsoever. Now let's talk about regulation of consumer credit as a means of qualitative credit control. Now, regulation of consumer credit. This method was first used in USA in 1941 to regulate the terms and conditions under which the credit is repayable in installments. And this could be extended to the consumer for purchasing the durable goods. Under the consumer credit system, a certain percentage of the price of the durable good is paid by the consumer in cash, which is commonly known as the down payment. The balance is financed through the bank credit, which is repayable by the consumer in installments. Now, how can the central bank control credit with the help of this method? First and foremost, by changing the amount that can be borrowed for the purchase of consumer goods and consumer durables, and secondly, by changing the maximum period over which the installments can be extended. This method seeks to check the excessive demand of durable goods in the market and thereby control the prices of these goods also. It has proved to be very effective method in controlling the inflationary trends in developed countries, where the consumer credit system is widespread and prevalent. In underdeveloped countries, however, this method has less significance where such a system is yet to be developed. Now let's talk about rationing of credit as a method of qualitative credit control. Rationing of credit. Credit rationing is a selective method of controlling and regulating the purpose for which the credit is granted by the commercial banks. Now, rationing of credit may assume two forms. The first one is the central bank may fix its rediscounting facilities for any particular bank. Secondly, the central bank may fix the minimum ratio regarding the capital of the commercial banks to its total assets. Because when the commercial banks will have lesser amount to advance as credit, it will be automatically regulated and controlled. In other words, credit rationing aims at, first, limiting the maximum loans and advances to the commercial banks by the central bank, and secondly, fixing ceiling for specific categories of loans and advances. Now let's talk about moral suasion as a method of qualitative credit control. Moral suasion is nothing but morally persuading. According to Shadler, in many countries with only a handful of commercial banks, the central bank relies heavily on this method of moral suasion to accomplish its objectives. Moral suasion means advising, requesting, and persuading the commercial banks to cooperate with the central bank in implementing its general monetary policy. Through this method, the central bank merely uses its moral influence to make the commercial banks to follow their central policies. For instance, the central bank may request the commercial banks not to grant the loans for basically speculative purposes, because this might lead for inflationary pressures. And similarly, the central bank may persuade the commercial banks not to approach it for any kind of a financial accommodation. This method is a psychological method, and its effectiveness depends upon the immediate and the favorable response from the commercial banks. The next qualitative method on the list is direct publicity. The central bank also uses publicity as a method of credit control. Through publicity, the central bank seeks, first, to influence the credit policies of the commercial banks, second, to educate the people regarding the economic and the monetary condition of the country, and third, to influence the public opinion in favor of the monetary policy designed by the central bank. The central banks regularly publish the statements of their assets and liabilities, reviews of their credit and business conditions, reports on their own activities, money markets and banking conditions, etc. From the published material, the banks and the general public can anticipate the future changes in the policies of the central bank. But this method is not very useful in the less developed countries because the majority of the population is illiterate and they do not understand the significance of the banking statistics. The next one is direct action. This method of direct action is most extensively used by the central bank to enforce both quantitative as well as qualitative methods of credit control. This method is not used in isolation. It is often used to supplement the other methods of credit control. Direct action refers to the directions issued by the central bank to the commercial banks regarding their lending and investment policies. The direct action may take different forms. First, the central bank may refuse to rediscount the bills of exchange of the commercial banks whose credit policy is not in line with the general monetary policy of the central bank. Second, the central bank may charge a penal rate of interest over and above the bank rate on the money demanded by the bank beyond the permissible and the prescribed limit. And third, the central bank may refuse to grant more credit to the banks whose borrowings are found to be excess of their capital as well as reserves. So this was all about the qualitative or the selective credit control methods. Stay tuned for more in our next videos. Thank you so much.